I got a message from a YouTube subscriber wanting me to make a new video about bringing on financial partners for equity. So we're going to talk about that today. Hey there everyone, it's David Barnett from davidcbarnett.com, the blog, YouTube channel, iTunes podcast, where we talk about small business, buying, selling, managing, financing, anything else you guys ever ask me about. I live to serve. Honestly, I do. So this week we're going to talk about bringing on a financial partner for equity. And a couple of months ago, I did a video about equity financing. And what we're going to talk about today is more about the actual relationship between the person who's trying to put the deal together and the equity partner. So first, let me give you a framework. So why would we want to have an equity partner? Well, first of all, if we're going to buy a business, let's say, you're going to have to get some money together and you're going to give money to the seller, and the seller is sometimes going to finance part of the transaction. But a lot of the time we're still going to be reliant upon, for example, a bank to make us a loan. And in order for us to satisfy the bank, we sometimes have to have a certain amount of skin in the game, our own money invested in the deal. And the banks typically talk about this with respect to debt to equity ratios on their opening balance sheet. So if you look at a balance sheet, you got assets on one side, and on the other side you have liabilities and then equity underneath. And they'll say, for example, that the most debt they want to see in a business is a 3-to-1 debt to equity ratio, which means if for every $3 of debt that the business is going to have, they will allow $1 or they're going to require $1 of equity. And of course, anything below those $3 of debt for every $1 of equity makes the business stronger, makes the deal stronger, and importantly, less risky for the bank, which is often why they're looking for equity. Now, equity typically comes from the pocket of the business buyer. And of course, what do you do if you don't have enough money? Well, a lot of people unfortunately just tuck tail between their legs and walk away and consider themselves defeated. But of course, you don't do that because you watch me, and I'm going to help show you some of the things that you can do to get more equity in the business. So, first thing, is there any way to make debt look more like equity? So there's a bank that I know of, for example, where if a seller does a vendor financing and leaves his principal in the business, so he agrees to have no principal payments on his vendor takeback for 5 years, the bank will actually consider that debt to be equity because it isn't creating a cash flow drain on the business. Okay? So here's the other mentality that the bank has. They want a certain amount of equity because they know that debt has a cash flow demand. And if creditors are sucking the cash out of a business, it makes it more difficult for the business to succeed. So what are some of the features of equity that make it so nice from the bank's point of view and even from our point of view as entrepreneurs, right? So if I buy the business and I put my own cash in, right, to make the equity, and I borrow money from the bank, do I require a certain cash flow to myself? Well, I might take a salary for the work that I'm doing, but I don't require, for example, a dividend on my own money because my interest is in the long-term success of the business. I want to make sure that there's enough money in the business to pay the debts and to make sure that I can invest in new equipment and take care of all those things before I decide to take extra money out as a dividend to myself, right? So equity does not necessarily have a demand on cash flow. And that's one of the neatest features that make it so nice over debt. Now, here's ultimately though what I'm trying to do when I'm an equity owner in a business is I want to hit the home run. So 20 years from now, after I've been operating the business successfully, theoretically the debts are paid off, the bank's been paid off, and guess what? Who owns all the cash flow now, or who gets to take advantage of all the cash flow? Me, because I own the equity. So that's the play. Right? I put money in today. I don't require a return on it immediately in hopes of getting a much greater return on my money down the road. People who invest in the stock market will often tell you that the equity, the shares of the company, need to yield a higher rate of return than the company's debt because the company's debt is often secured, or in the windup of a public company, if a company is dissolved, all the debt holders get paid before the shareholders. So there's more risk in owning equity. So if I don't have enough equity and I'm trying to please a bank in order to make a deal come together, how do I have a conversation with someone to invite them to become a financial partner for equity? Well, here's the thing. When you watch things like Shark's Tank and Dragon's Den, people are trying to get the equity, right? Because they see the opportunity of the business to grow really big, and they want to get their hands on part of that equity because they can see that they're going to get money down the road. When people like you and I are talking with other everyday people and you're trying to buy like the tire shop's not going to grow 100 times over in the next year, right? The tire shop is probably going to be 20 or 30% bigger in 5 years than it is now if you're a good manager. So we're not talking about explosive growth. So we're not talking about the Shark Tank people trying to get a hold of a part of your business because they think that they're going to make 10 times their investment on your business. What they're typically looking for is a better than average rate of return. So they want to be compensated for the risk. And in almost every case with a small business, they're actually not investing in the business, they're investing in you, right? Because they probably know you. I've said it before, I'll say it again. When you go and try to sell equity in a small business, you have to be aware of securities legislation and laws, which typically say that as long as you're selling to your family, your friends, people that you know intimately, you're okay, but you can't go and approach strangers unless you've put together what's called a prospectus, which nobody can do at this level because they're too expensive, or you follow one of the other exemptions, such as you're talking to an accredited investor or someone's doing a minimum transaction in certain jurisdictions that qualifies them. So you have to find out what the rules are where you live, okay? So now that you've found out the rules where you live and you want to approach someone and talk with them about becoming a financial partner in your business, here's how the conversation goes. You say, look, Uncle Ted, I need another $20,000 to put down to get into this business, so the bank will lend me the money and then I can make the deal happen, and the seller's financing part of it too, but I need $20,000 more equity, which means I can't make any payments or offer dividends or anything like that. There's a couple of different ways that you can structure that equity for Uncle Ted. You can make him a preferred shareholder, so you can create a new share class, and the rules though of that share class have to prevent cash flow if the company can't afford it. When the banker sees that you've got more than one share class or you've got other partners coming in with equity, they're likely going to want to know what the conditions of those terms are, because if you say to Uncle Ted, I'm going to give you a preferred share yielding 10% and the dividends have to be paid every year, the banker's going to look at that equity and he's going to call it debt because it's going to create that requirement for cash flow, right? But if you say to Uncle Ted, I'm going to create a 10% cumulative special share class for you, preferred share. What that means is every year you owe Uncle Ted 10% dividends on his investment, but if the company doesn't have sufficient cash, you don't give it to him. It becomes a dividend payable. It's now part of what you owe Ted, all right? So that kind of structure is very clear and easy to understand. And if the business fails, well, Ted owns preferred shares and your shares are worth nothing, and well, you know what? His shares are going to be worth nothing as well. And that's one of the things you have to make clear to these financial partners, is that they really are gambling on the success of the business. Just like in the stock market, if the company goes bankrupt, they're likely going to end up with nothing. Now, the other way to do an equity deal with a financial partner is to actually have them become part owner with you, meaning that they're going to buy some of the common stock. Now, when you do that, you have to be very aware of what they believe is going to happen. So let's say you buy a bar or a restaurant and somebody kicks in part of the equity that you need and they're owning 40% of the business, you own 60%. Do they think that they get to show up on Friday nights and drink for free? Are they going to show up and start telling employees what to do? Are they going to criticize the menu and then talk to suppliers and call you up because they talked with so-and-so who really should be playing on Friday night because he's great at guitar? You have to define the rules. What exactly is this person going to be doing in the business? Because strictly speaking, a shareholder has nothing to do with managing the business. But if you don't create those expectations clearly in the minds of your financial partner, you might end up with someone hanging around that you never thought would be hanging around, and they might not actually be very good at running the business that you're buying. So you have to define the relationship, you have to define what's going to happen, and most importantly, the big difference between someone who's going to be a financial partner with you buying a local business versus, Kevin O'Leary at the Shark Tank is that Kevin O'Leary wants to own his shares long term so the company becomes more valuable and he gets out when the company is sold to someone else. Local financial partners in small businesses, they need another access or exit or path to liquidity that could happen before the business is sold. So a lot of the times what I've seen people do is they'll actually create a valuation formula in a shareholders agreement saying that after a certain number of years, say 5 years, the majority shareholder, you, have the option of starting to buy back those shares from that other shareholder, and here's the formula we're going to use to calculate their value at that time. Because ultimately an individual, particularly an individual who has money to help you buy a business, is probably going to be someone who's more established in their life. So it's not a 20-year-old, it's probably a 40-year-old or a 50-year-old or a 60-year-old, and they're thinking about the span of their life. So they can't have their money tied up with you for 50 years or 100 years. They need a way to get their money back out over a reasonable time frame. So if you're going to offer them a certain rate of return as a base, or you're going to offer them a valuation method based on the sales of the business or the profit of the business, you need to show them how they're going to be able to get their money back out and how they're going to be able to make a rate of return that makes sense for the risk, right? And what I often find interesting is that when people start to look at what kind of rate of return and deal that their financial partner should be getting in order to risk their money, they start to actually consider what sort of demonstrable rate of return and return that they think they're going to be able to get on their own money. And I've actually seen some people back away from some deals when they realize that they're about to put a bunch of their own money in as equity and the rate of return isn't there for the risk being taken. If you want to learn more about being smarter when you go to buy or sell businesses or about business in general, you should be buying and reading my books, of course, and you can find them on Amazon or over at davidcbarnett.com. And if you want to buy a business, go to businessbuyeradvantage.com, take the online course there. I've been selling it to people for years. Hundreds of people have done the course. 30-day money-back guarantee. Not a single person ever has asked me for their money back. That's how confident I am in the value of businessbuyeradvantage.com, the online course. And of course, if you own a business and you're trying to get it ready to sell, go to howtosellmyownbusiness.com and pick up a copy of the book as well. Cheers. Get over to my website, davidcbarnett.com, and sign up for the email list to get videos like this in your inbox every week. Thank you so much, and we'll talk to you soon.